Good morning. I wanted to cover real quickly for you this morning the collapse of Silicon Valley Bank. You might think it's unrelated completely to you and where you bank and those things, but how does it relate? So here's the situation. Silicon Valley Bank is very funded and deposited by venture capitalists. Above 90% of their accounts are over 250,000. So we're talking about a bank with large amounts of money in each account, and not like a typical bank. We have small depositors, and these depositors has been decreasing the money in the bank over a period of time because interest rates are higher. And in the industry, the banking industry, one of the assets they have on their books to stabilize their portfolio is government bonds. And right now, over the last couple of years, because interest rates are rising, government bonds have been losing money. And so right now, as of December 31st, there's about $600 billion in losses on the books of banks across the nation. Now, I think the number was about 17 billion that was on SVB's books, and their deposits were increasing, so they had to go and tap these. The other banks did not take losses as the market value of these assets decreased. If they had, JP Morgan would have, I think, lost on their books about $27 billion minus their net income, and they would have had to net out those. But instead, what the banks did was they reclassified their bonds as held to maturity. So the way a bond works is if you buy it for $15,000 or below market and you hold it the 10-year period, you get the money back that it says. Okay, so you don't lose. But if you have to sell it after 2 years or after 3 years or 5 years, then you lose the difference between the market value and that maturity value that they're holding on their books. And so that is what they did. They reclassified it. So if you look at the bank, what you're looking for is two things. Number one, you're looking, did the bank, do they have losses in the books? If so, how big is that compared to the assets that they have to cover those losses? And the second thing is, are they decreasing their overall deposits significantly over time where they might have to tap those assets? Now, one take that I would have is if an asset is only tappable when you lose $27 billion, I'm not really sure that should be considered an asset. $27 billion is a lot of losses to take, and possibly the accounting should be that when the interest rates increase and that asset goes down in value, they should have to take those losses on their books. But if they did that, the banks would be currently undercapitalized because of those losses. And so that's what's going on. So your bank, you don't need to worry about it unless there's a run on the bank, meaning there's a decrease in deposits over time like there was at SVB. In addition, your bank could have exposure to these bank failures, right? So one bank may have money in another bank. So in this situation, the largest loss I've heard of is from Roblox. I believe it was Roblox. And they said 25% of the money, or $500 million, was in SVB Bank. Now, what will happen is the first $250,000 they'll get back on Monday from FDIC insurance. The other part, the FDIC is giving them a piece of that or an IOU for that, and based on the outcome of the breakup of SVB Bank or the sale of the bank, there'll be a percent of that paid to that company. And so if you're a holder in that, you might, I think it's Roblox. No, it's not Roblox. It's Roku. You might look at that. But this is what's going on. There's a couple of videos you can look at. One talks about Charles Schwab and a couple other banks and looks at their balance sheets and compares that to their assets and shows, here's the situation this bank is in. I didn't see the same kind of effect coming out of this particular bank failure that happened with Lehman Brothers or Bear Stearns, because they were cross-securitizing the banks, so they held debt from other banks, and so that's kind of how that trickled up. This is a separate bank, and so the underlying problem, though, might affect other things, which is the $600 billion loss on the increase in rates. Now, the increase in rates is not done, so that loss is not done. So if it has went up by, let's say, 2% now, and it's going to go up by another percent, that could equate to another, $400 billion. We could be at a $1 trillion loss in the banking industry on those government assets, or just on the government assets. Now, I have some government bonds I've bought. Mine are under a year, and so you generally have the same, level of loss, but the bondholders of long-term government debt were definitely losing money in this situation, and on their books they are not taking those losses currently. They're just reclassifying the assets as held-to-maturity assets, things they're not going to sell. So maybe they'll make it through, maybe they won't. The main thing to know for you is make sure that you don't have over $250,000 in cash in a single account at this bank, or you'll not be FDIC insured. The FDIC insurance, I think, is going to work. It's going to pay out pretty much no matter what happens, and I think the government will probably just print money if they need to continue having FDIC insurance, because that's what avoids the small depositors pulling all their money out of their banks. So that's my take on it. How do you make money in this situation? Well, bond yields dropped a little bit. Possibly the interest rates won't go quite as high because of this fear from the Fed, and if they're not afraid of this, they should be, because essentially them raising rates might cause them to have a $1 trillion banking industry bailout, or other corporations have to be bailed out that they can't afford to fail, like they did AIG in 2008. So I'll keep an eye on the situation, but that's what I see at this point. Have a great day. Like and subscribe if you can, and I'll talk to you later.